Welcome to Making the Grade, the podcast that explores what's driving the decline in graduation rates between funding rounds and what it really takes to scale a venture-backed software startup successfully with realistic options to exit. I'm Tom Glasson, CEO at Scalewise, and each week I'm going to be joined by founders, investors, and some of the best go-to-market leaders in the world to unpack the strategies, the missteps, and the mindset shifts that separate those who graduate from those who don't. Expect real talk, actionable go-to-market insights, and honest stories that will help you scale more wisely and thrive in an increasingly competitive market. Because there is a smarter way to scale, and we're here to uncover it. While VC often dominates the headlines, more often than not, the VC route probably isn't the best fit for a business. So what do you do if venture capital isn't the right path for your startup? Well, in today's episode, we're going to be unpacking the evolving world of startup funding and why VC might not be the best fit for every founder or business. From investor dynamics and growth expectations to exit strategies and go-to-market missteps, we're going to be challenging the traditional narrative and exploring what alternative paths to scale could look like in 2025 and beyond. And to help me do that, I'm joined by Eyal Malinger and Oren Peleg, the co-founders of Resurge Growth, a new kind of investment firm pioneering a model they call venture equity, which blends the best of venture capital and private equity to better serve ambitious, capital-efficient founders. So if you're fundraising, scaling, or starting to eye up an exit, this episode is packed with insights and actionable advice for you. So let's dive in.
Eyal, Oren, welcome to Making the Grade. Actually, our first ever in-person Making the Grade recording.
Pleased to be here.
Yeah, really glad to have you. How are you guys today?
Great.
Well, can you start us off maybe just giving us a bit of a whistle-stop tour of your careers and maybe how you've come together to create Resurge Growth Partners as well? That would be great. Maybe starting with you now.
Absolutely. So my career started as a software engineer. I come from tech. I love tech. I'm always obsessed with tech. I then moved into the world of consulting and worked in private equity for a number of years with Oren together at a fund called Oaktree Capital. And for the past 10 years, I was in venture, first in the corporate venturing, and then for 7 years, I was in the fund called Berengia, or the partner there, and got together with Oren based on the opportunity we saw in the market.
So I started my career as an analyst in private equity, actually in banking, when private equity was within banking a long, long time ago, when 50 million was considered a mega fund. I then moved to consulting where I was at McKinsey. I was eventually a partner. My early exposure to private equity then brought me back into it because I came to the conclusion that private equity would benefit from having operational skills to complement investing skills. And I kind of led the operations team in 2 private equity firms, the second one of which I was one of the founders that helped build it. Probably relevant to what I do today. When I was at Oaktree, we did a lot of what we called platforms. These were companies that we literally built up from scratch, and we can spend time on that. And then I stepped down from Oaktree to turn around the fund's biggest exposure, the fund's biggest investment, which was Fitness First. And then I migrated into the venture ecosystem, initially because I wanted to learn what was going on, and then it sucked me in and kept me in. And to some extent, I did what Resurge does today on my own company side, working with different companies that I invested in and kind of refine my thoughts. And that led to the launch of Resurge.
Well, we'll jump into that in a bit more detail, but clearly you've both got a huge amount of experience in investing. And common trend that I see is that VC doesn't really work for everyone. Yet tech founders often have sold that dream, that VC dream as being the only path. Maybe you can explain in a little bit more detail about what the alternative approaches to VC are, and I suppose why you're building Resurge Growth Partners as well.
So I think one of the observations that we both made, and we came at it different ways, because Eyal and I used to work together, then we parted ways, but in some ways we had similar exposures and different exposures, complementary exposures, both within private equity and with venture, is the observation that we made is that the VC model is designed around this idea of the power law. They back their winners, but it's not very few companies can deliver triple, double, and become unicorns. But actually the venture ecosystem, the innovation economy generates really, really good businesses, but not all of them can become these stars. And that generates a whole raft of businesses that when markets are normalized, you have to remember, there are times when there is so much liquidity and so much speculism in the market that everything gets funded, as we probably saw during the COVID era. But when you move to a more normalized market, there are good companies that venture look at and say, you are a good company, but I can't afford to fund you because I got to back my winners and you're not going to deliver fund returners. And they can get left behind, and they're good companies and they deserve to be funded. And that's the ones that we focus on.
We very often think about this as the gap between venture capital and private equity. Right? I think one of the reasons, and when we came into Resurge, the gap we identified in the market was we would hear founders come and tell us, look, I've got a great business. I have a great team. I have a great product. I've grown to 10, 15, 20 million of revenues, but I have a problem. I cannot raise capital. I'm only, with quotes in inverted commas, I'm only growing 30%. And coming from the private equity world, 30% is damn good. It's a really good growth rate. But in venture, it actually doesn't cut it, right? A company growing 30% will not create the unicorns and the venture scale returns you needed. And that created this gap in the market for companies who are good companies, but not growing fast enough for venture. And that's where we come in with our product.
We call our product venture equity.
Tell me more about that.
Well, it hopefully it captures, we wanted a new name because we're trying to cut through and for people to pay attention to what we're trying to do. But I think it also captures what we're trying to do, which is we're not really doing private equity because we are backing businesses and helping them that have still got a long way to go, right? They're not the mature businesses that private equity invests in. But at the same time, we're not doing venture because we are buying businesses that have traction, where you could step in and see, this is what they're selling. These are the customers. This is the problem they're trying to solve. They're doing it well. These are the operational processes they would need. This is how they would scale. This is how you need to build the business. So it is really a hybrid of the two. And what we're trying to do is to bring the best of both worlds. So one of the observations I made when I came from private equity to venture is, despite 25 years of doing operations in private equity, there's a big difference if you're trying to manage a business that's growing at 10% a year to a business that's growing 5% a month. And it's about bringing the best of both worlds is effectively what we're trying to do in Resurge. And that's why we've combined the two names and came up with venture equity.
I love that. It feels like you're innovating in a space which, we clearly know that the tech startups that we invest in, that we work in, are hugely innovative, and there's new business models coming out the whole time. But that innovation hasn't seemed to have happened really in investing. Why do you think that is?
So I don't know. I'll comment, and then I think Eyal has some strong views. I think there's a couple of things. First of all, you got to remember that if I drew you a picture of the US 10-year yield curve since the 70s, it's just come down, 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 down. So what's basically happened is, as the venture ecosystem grew, it was in a period of continuous declining yields, and therefore investor risk appetite just grew and grew to the point where we reached zero cost of money. So for a start, there was this, the industry just exploded, the amount of willingness to take risk. Second of all, that created a lot of inertia. So if you look at the venture ecosystem today, everything's built around venture, whether it's media, whether it's the resources, the infrastructure, the advisors. So there's a lot of inertia. And I think you need a correction, a dislocation like we have now, for people to take a step back and say, are there different ways of doing it? And then change takes time, right? It just takes time because there's so much inertia and so much infrastructure built around the VC model.
One of the main arguments people say is that LPs and investors don't like innovation, actually, in what they're investing. They are used to the 2 and 20, the 2% management fee and 12% carry across asset classes. And, you hear quite often, don't innovate on how this thing works. We want plain vanilla, innovate on what you're investing. But we do think there's an opportunity to evolve the model.
So for any founders listening to this, which I'm sure we will have, who may be deciding which route to take, can you share your advice on whether they should go down the VC route or seek out alternative options? So how do they determine which route to go down?
Yeah. The big question for founders to ask is, do I want to build a venture-backed business? And to do that, I think, first of all, go and understand what does it what does it mean to be venture backed, understand how venture capital works, understand what the model of a VC fund is, and try and think, do I fit in that? What do I mean by that? Venture capital is a 1 in 10 business model, or 1 in 20. Right? There's one winner in every portfolio, maybe two winners, hopefully, and they're the ones who are going to return all of the funds. They're the ones that VC really, really care about. So you then have to go and look in your business and say, do I think what I'm building here can be worth, pick a number, $1 billion, $5 billion? Because these are the numbers that a venture capital fund needs to see an exit at in order to return the fund and make money. So number one, can I build a company that is worth more than $1 billion? Number two, can I convince the market that I can build a company that is worth more than $2 billion? That is not very easy. Number three, do I have in me, or do I think I have in me what it takes? And I like quoting Reid Hoffman. Reid Hoffman, again, I don't necessarily agree with the blitzscaling theory, but he talks about starting a entrepreneurship journey is like jumping off a cliff and believing you can build an airplane on the way down. If you are okay with a very queasy feeling, I get just thinking about this, then I think this is a good model for you. And also understand where your energy comes from. Am I really going to enjoy this journey? So these are probably the three questions you ask.
Absolutely. And obviously, founders can sometimes underestimate that VC journey and maybe the personal risk that's involved in chasing that kind of bet on the farm dream. For founders that maybe don't tick those boxes that you just outlined, Eyal, what steps can they actually take then to actually get on a different path? Like, how do you advise them? Because it sounds like most founders really probably don't meet the criteria that you've suggested there. So there needs to be an easy route into an alternative path. What do you see as that path?
I think seek lots of advice. Interesting, as someone who came in from outside the venture ecosystem into the venture and to the innovation economy, I've been immensely impressed by the resources that founders are given.
Mm.
But those resources are all driven around venture. It's a point we were talking about before. I think it's also important for founders to explore the world outside of venture, because there are, in the private equity world, for example, there's really innovative use of balance sheet structures, alternative sources of capital. There's lots of pools of capital there. And also there are continuous pools of capital emerging. I'll give you an example. Probably the most powerful growing pool of capital at the moment is the family offices. But you cannot categorize, whereas we're trying, maybe unfairly, to categorize VC in a stereotypical way in this podcast, and it's probably unfair. You can never do that to a family office. I've been with one family office where they've got 20 professionals, which they've hired from banks. I've been to another family office, which is enormous, where it's literally the entrepreneur managing the office on WhatsApp, right? Making all the decisions. Mm-hmm. But the point is, there are lots of pools of capital out there. The world is flush with capital, looking for good ideas. And there's lots of advice that founders can take about different structures they can pursue. So I'll give you another example just to bring this to life. I'm working with a company at the moment that adds a lot of value to real estate assets. Now, it could continue to just fund itself in a traditional VC way, or actually it can start to consider, which it is, partnering with real estate private equity funds that have assets that are looking to drive the yields from them. So suddenly it's just tapping into a completely different pool. It could create a different vehicle that goes after certain asset classes. What I'm trying to get at is there's lots of ideas that founders need to think about, but they need to access those ideas from a much broader population, some of which is sitting outside of the venture ecosystem, because the venture ecosystem actually is not the place to go to, what I would call, for balance sheet sophistication, or in plain English, kind of being really smart at accessing different alternative sources of capital.
Yeah, really good point. And Eyal, obviously, one of the reasons why this podcast is called Making the Grade is because we've seen this big decline in graduation rates to the next funding round over recent years in particular. I know that you've talked about in venture graduates, but maybe in a slightly different context. Maybe you can share your thoughts about how founders that are on that VC path should think about moving off it and what that might look like for them.
The fact is, the move isn't a very easy one. And that is part of the reason we started Resurge, right? The way some of us think about it is there are two parallel train tracks that don't really meet each other, right? You're on the venture track or you're on the private equity track or on the bootstrap track. And one of the initial drawings actually we had is off-ramp, right? How can we create an off-ramp off of this venture track? And the venture track, the way I would characterize it is you raise capital, you burn the capital, you grow, and you grow enough to convince the next fund, the next station of the train to say, oh, this looks like it's growing really well. Let's give it more money, put more fuel in the tank, burn and grow. If you want to get off that ramp, number one, I do suggest give us a ring. We're happy to talk and see how we can help with that. But I think it's the number one thing you have to do is understand your strategy. Where are you trying to get the company to? I'll give an example. Maybe you're looking at the market and you're thinking, actually M&A might be the right thing for me. Maybe I should go and buy and build and roll up more companies in my industry. If that is your strategy, go and find the right investors who will back your strategy. The other point I will make that's really important, and we do it on every deal we do, and I think entrepreneurs should do it themselves even before we talk to them, understand your cap table. Go through a cap table and really understand who are your investors, what are their motivations, and actually go and have a coffee with them and say, hi, Tom, you've been with me for 7 years. What are you trying to get out of him? Right. And I think actually having these discussions, which may sometimes be a little bit uncomfortable, will help you understand where you are, where you want to go, and what would be the right funding support to get you there.
Such an important point. I've seen countless M&A opportunities fall apart because of misaligned kind of investor incentives or just messy cap tables. What are some of the key conversations you think founders should be having with their investors early on to ensure that they have that kind of flexibility in terms of future strategic decisions like M&A? How can they kind of almost sow the seeds of that path early on? Any thoughts on that?
I think it's very much what Eyal was saying, which is you were on this path. I think is really figure out what is the right strategy for the business and where do you want to take the business, and then have a real strong reflection on the cap table and say, is this the right cap table to get me there? And cleaning up a cap table is not easy. You're going to need help doing it. But if the cap table doesn't suit what you're trying to do with the business, at some point, you're going to have to sort that out.
And at a point, we are finding, and we've learned, I would say the hard way, that founders think they know what their investors want, but actually they don't. Because again, they think because they spoke with them maybe 2 or 3 years ago. I cannot recommend enough sitting down with your main investors and actually understanding what are the motivations, what they want, and understanding, is there alignment here, right? You very often find that out of your 4 investors, one of them is really keen, they have fresh capital, they would love to back an M&A strategy. Great. And another one, all they want to just get out and gets money from LPs. And so having the discussions is very, very critical for you to understand what options are available to you as a founder.
One practical point I'd like to add is quite a few businesses that we're coming across have a chairman or have someone on the board who is maybe not an investor, but more an operational advisor. Leverage them because they may have that experience. Plus the founder's actually trying to run the business, right? So if you've got a chairman or you've got someone on your board who you can task with this, that would also help. Set them the goal of saying, and if you have a chairman and they're not doing this, then you should definitely task them to do this.
Great. Well, let's move now on to some of the challenges maybe or issues or problems that you see get made. You've got a lot of experience working with founders over the years. What do you see as some of the biggest or most common mistakes that they make in the early stages of scaling? And I know there's lots, but what are the most common ones?
So there's a couple. And by the way, in all credit, and again, we're talking generically, we're seeing a lot of this change, especially post the correction. But some of the common ones that we see that have hurt businesses are the following. One that I have a real bugbear with is, and I raise this because I often think this is the board's fault, not the founder's fault, is make everything look like SaaS, even if it shouldn't look like SaaS. So we do come across quite a lot of businesses where the board or the founder trying to make the business look like SaaS because, and I get it, SaaS gives you great payment terms to grow the business. It gives you recurring revenue. But when you look at what the customers want, they don't want SaaS. Either they don't use the product frequently enough, or actually they are very conservative and they want to test the product before they commit to a contract. So you would have had a much easier sales process had you just said, test it, pay me on usage, and then let's have a conversation in 6 months. And it probably would have allowed you to drive much better pricing later on. Another one is understanding your market. We've seen quite a lot of businesses that took off, got incredible growth, and then suddenly tapped out. And they tapped out because they never took enough time to really, really, really understand their customers, their segmentation, both within the market where they were operating, plus the new markets they were entering. And therefore, they didn't localize enough. So it's really understanding how the market is segmented and how your product should adapt for each one and what's the use case. And often, if you have very strong early traction, it can make you lazy. I could go on and on, but another one, which I think is really interesting, is what I call lazy marketing. So, I've got gray hairs, I'm in my mid 50s. When I started my career, marketing was an art and it needed more science. Today, marketing has become an utter science, and Google and Meta have pushed marketeers to become scientists. But I think they've lost the ability to do it, anything creative with it. There's so much laziness because of that. And we see a lot of marketing execution, which is just pure science and not enough of the art, if that makes sense. And that's going to change now, right? Because search AI is going to force every marketeer to think differently, because the search itself will generate 6, 7 names as opposed to everything that it does. So that's another area. And the final one, which is really important, where we see a lot of, is around unit economics. So we observe this obsession with gross margin. However, what we look at is the unit economics all the way of what we call by channel, by customer, in terms of what it really costs to serve and retain that customer. And often when you start to allocate the below the line cost, we see a lot of businesses that actually, if they continued to scale, they'll just drive themselves into a hole, because a proportion of their business that they were growing was systematically losing money on a fully costed basis, if that makes sense.
Yeah, I mean, it's that focus on unit economics, which is forced by the cost of capital going up, and you now need to drive profitable, efficient growth. But what do you believe then are the most important metrics that founders should be tracking now as they're scaling? Clearly, gross margin. Let's not obsess over that. But what should they be obsessing over?
I'll try to refine Oren's point, and that is, when people look at CAC LTV or CAC payback, people need to consider cost to serve. That is right. I think that one of
to convert and cost.
So people really focus on the CAC and lifetime value and the gross margin. Say, okay, what is my cost to acquire the customer? But they forget that many of those customers may have a much higher cost to serve.
Yeah.
And what will happen, you may have two segments. One segment of the clients, they look the same, but actually one of them are taking a lot more of your professional services resources or a lot more of your customer success resources, and you're making no money out of them. But unless you really have a deep understanding of your cost to serve and your actual gross margins, you will not know it.
And balance sheet costs. So when we look at unit economics, you've got some customers where sometimes the founder says to us, these are very low margin, but actually their working capital profile is really, really positive. And it becomes really relevant as the cost of capital goes up. If you have a customer that has great payment terms and another one that has terrible payment terms, a lot of people aren't considering that in the cost, in the true profitability of that customer. But with capital now costing a lot of money, that is also a cost that you need to factor in your unit economics.
Absolutely. What do you think of metrics like LTV? I've always had a question mark over how companies sometimes calculate lifetime value when they're projecting out, multiple years, especially when you think about this, everything is deemed as SaaS, when often, you can't guarantee that customer is going to be with you.
So I've spent a lot of time thinking about that question. Number one, I'm a big fan of CAC payback. Because that question has nothing to do with the lifetime value. It is just how many months does it take you to pay back a customer you acquired? And a lot of metrics around that, but that is one thing you know. The problem with LTV is you don't know how long the life is for most customers. And usually most of the startups we would look at would not have enough years of life to actually justify, say, oh, we only have 60% churn, so our lifetime value is almost 20 years. However, I would say that things differ between consumer subscriptions and B2B SaaS, right? I think in consumer, when you have enough data, enough cohorts, enough distribution, you can actually create very, very good analysis and understand, oh, these customers, the average life of these cohorts is 3 years, and you can get very granular and get a number. On B2B SaaS, unless you are doing the little bunny Dropbox kind of 10 pounds a month, it's quite hard to get to the L part of the equation.
Absolutely. So countless examples of founders that I think don't last the course from kind of seed through to maybe later stage, maybe IPO, but maybe they feel the pressure to be doing that. And you obviously have some good examples, people like Zuckerberg and others that have successfully made that journey. But often what I've seen, and I've seen this countless times, they get exited or they move into a kind of president role or an evangelist role, or maybe even completely from the business. And there's a non-founding CEO that comes in to that seat. What advice do you have for founders who are wondering whether they should stay at the helm for longer? Any thoughts from you, Eyal, on whether how should they be thinking about that?
This is a question we ask ourselves a lot, and I think the challenge we have in this industry, I call it the CEO hero seed to IPO narrative. And yes, you have Zuckerberg, right? But that is the one out of I don't know how many tens of thousands of entrepreneurs who try. The main advice is introspection, right? Really, really know yourself and understand where your energy is coming from. Are you enjoying building stuff, and are you enjoying managing? Right? Are you enjoying, because things are going to grow, and if you're managing 10 people now and you really hate it, and you're going to manage 50, you're going to hate it even more, you're going to 1,000, right? You're going to be building, the more the company grows, you'll probably be building and doing less and less and managing more and more. And so understanding where you get your energy and joy from is really, really important. And if you realize, well, you know what, I just love sales, or I just love product, or whatever it is, that is good. This means you can say, you know what, I'm going to bring an MD or a COO or whatever it is to help me run and grow my business. Oren has something to do.
Yeah, no, I completely agree with that. Is really know what you're good at and what you're not good at, and build a team around you that complements you. It's interesting, having come from the private equity world where we rarely kept management team. We always changed them. One of the biggest learnings for me in the venture space is just how important founders are to the business. And therefore, I've not applied kind of my brutal private equity approach in the venture world. The conversation I try and have with founders is, what do you want to spend your time doing? Let's talk very openly about what you're good at and what you're not good at. And now let's build a team that really complements your skills, but try and avoid a scenario where you try and turn someone into an all-rounded CEO if they're never going to make the grade. It's much better to surround them with the resources. They're going to be a lot happier.
Yeah. I love both the points. The introspection point, I think, is so important. And the best founders that I've worked with have had that innate understanding of where their strengths lie, where their passions are, and what they want to be doing. And I also love your point. Don't just exit them. They've got some value to the business. And if you can harness that in some way, then that's a great way of doing it. Any advice for founders that are kind of wondering, are they more of a builder? Are they a scaler? Can they make the grade? Because some will believe they can. A lot of founders are optimists. They believe that, well, I can take this company all the way. Any advice for them to kind of help them think about whether they are better suited to different stages and whether they should not let their pride take over? Because I think pride and ego can become a part of that founder's narrative internally.
So I had a mentor when I was in private equity, and one of the things he taught me was, because I was always on the operational side, he always said to me, look, don't think about it getting from A to B, which is the transformation that you have to deliver by the skin of your teeth. What I expect from you, Oren, is to deliver the company from A to B in the lowest risk possible, right? So I would urge founders to say, not to ask the question, do I have a chance of becoming this? It's kind of like, how much risk am I putting on the business, on my net worth, because all my worth is tied up on, by attempting to make this jump? And the second question is, how can I de-risk this journey? And what steps do I need to take to de-risk the journey? Because it's a risky journey as it is. You should be always thinking about it in risk terms and saying, how do I de-risk it?
I love that. That putting almost the company and the broader, I suppose, opportunity ahead of their own ego and pride.
Yeah.
And thinking about how do I de-risk it?
Yeah.
And am I doing the right thing by staying the course for longer than I need to? It's great thinking. So I would love to kind of start thinking about, I suppose, things that you would like to change about the startup ecosystem as we wrap up today's episode. And maybe starting with you, Oren. So if you could change one thing about the startup ecosystem, what would it be and why?
So, look, I came into the startup ecosystem as someone from the outside, and I'm in awe of what I'm seeing. The level of innovation, the creativity, the energy. The other thing relative to private equity was all closed and secretive. The openness, the willingness of people to help. So I think the support, the infrastructure, it's all there. I think what's missing is what we're trying to solve for, but we're not going to be the only answer. I think more people have to step up, and that is innovating in the financing, in options that are available to founders. Because at the moment, you have this great innovation ecosystem with not many models, i.e. principally the venture model, which is about the power law, which is about backing very few over time. It's, can we introduce more models? Now, the other criticism I would say is the one big innovation that's happened in the last 3 or 4 or 5 years in the venture ecosystem is the introduction of debt. But the traditionalist in me keeps asking himself, is that what loss-making businesses need? And I've got to get into hot water because there's an enormous venture debt market out there, and we're trying to work with them. But it just doesn't feel to me that is the ultimate innovation that the ecosystem needs.
Why doesn't it feel good to you?
Because I was brought up in very traditional corporate finance, which is you leverage up mature things that generate cash. When you have things that are growing and loss-making, you fund them with equity-like instruments. That maybe I'm just a traditionalist, but that's how my mind works.
So what about you, Eyal? What would you want to change about the startup ecosystem and why?
The main thing I see missing is education for founders, especially early on, to understand the journey they're going into. You hear it quite often from founders saying, "Oh, I had no idea what I'm signing myself up for." It's a 5, 7, 10-year journey. And as we said in the beginning of the podcast, the probabilities of having an outside outcome are really low by definition. And so really understanding what it is you're going into and what options are available to you within the venture or outside of the venture.
I just want to add one point, which is a positive, which is I think long-term is going to really be in play in favor of the venture ecosystem, which is, I think the resiliency has gone up a dramatic notch. And I'll tell you why. If you think about what founders have just gone through, they went through COVID, which for many founders was an utter shock. I was involved in one business where 98% of revenue literally disappeared overnight. And then they had the market correction, capital stopped flowing. And I think for a lot of and it's made up of a very young population. So suddenly they entered into this with, dare I say it, naivety, right? And suddenly they went through hell for a whole raft of reasons. And I think that's built an enormous resiliency and skill set as to how do I react in the crisis? And I think the ecosystem will be far better off for it because of the experience that everyone's gone through.
Super interesting. And this show is obviously called Making the Grade. We are very interested in how we can support more startups to make the grade, which is to graduate to the next funding round. And what do you think needs to happen, Eyal, to improve those graduation rates in startups?
It's hard to say what needs to happen. What I do know that in some roundabout way, the graduation rates are going to improve going forward because the funnel is getting smaller. And so what is happening, what we see in every cycle, you have tourist money coming into the ecosystem. And tourist money can be corporate venture, can be angel. So there's a lot of money coming in. And you see this in 2021 that funds a lot of businesses that should not make the grade in the first place. With the capital coming out of the system, I would say the quality of ideas that get funded is improving. And so we're going to see more companies making the grade as a result.
Super interesting to think that a tougher funding environment is a good thing. But it kind of is really, in some ways, it forces that focus on better execution.
Yeah.
It's more than that. I think there's a lot of research and studies on this. The best companies, the best startups have almost always been started in down years. And those down years were with the funding was scarce. So they had to start. Airbnb is a good example. Uber is a good example. Cloudflare had to start when funding wasn't abundant, had to build a real business early on, and only then funding came.
Yeah, completely agree. And what role do you think the investor ecosystem can play in helping startups to graduate more successfully beyond just the capital? Because I hear that, certain investors are just providing the capital and there's not really much else that they're giving to support that portfolio company. So what do you think they should be doing?
I'll give the answer, which I'm not sure many people will want to hear. And that is, especially in the UK, the venture ecosystem is very bad at cutting the cord. And that is bad for the ecosystem, right? The number of founders I see keeping on running against the wall, very little growth, not going anywhere, where any US investor would have said, you know what, this makes no sense, no more funding, buy or out. And this actually helps recycle people into the ecosystem, recycle money into the ecosystem, right? Why would you want to keep running this thing when actually, you know what, it's time to go home, shut down and start again. So I'm hoping to see a bit more of that happening. Right?
Final question for today is, a lot of founders, the kind of panacea for them is to have some sort of exit event, of course, a liquidity event. And there'll be founders listening to this that are maybe feeling they're not too far away from that. What's your biggest advice for founders looking to exit in 2025?
KYB, know your buyer. And by that, I mean, there's a very famous saying, which is true, which is the best companies are bought, not sold. Yeah. And know your buyer. If you talk to almost any successful exit, the company has known and worked actively as a partner with the buyer or in some other capacity for at least 2 years. And so if you're thinking about an exit, start now, making sure you meet all of the potential buyers and build relationships with them, either personal, professional, business partnerships, because they are going to be the ones who are going to get you the best exit price and strategic buyers.
Just to build on the same point, sometimes the buyer is not the obvious one. So I would just want to broaden the definition of know your buyer in terms of founders should also, as they go through that process, seek input that helps them just identify if the buyer is going to be someone that they're not expecting it to be. Because at the end of the day, if you're doing something really creative in that industry and that industry is changing, there may well be buyers that you aren't naturally thinking about that are looking and saying, actually, that's really interesting. That could be an extension of where I go to next. And sometimes you can convert someone to be a buyer. So it's really about thinking broadly, who could be the person to buy my business and who should I have those conversations with?
Brilliant advice. Both of you, Eyal, Oren, that has been an incredibly insightful discussion. I think you've given so much wisdom over your many, many years of investing and supporting founders and startups. And I'm really pleased that you're innovating in this space, much needed innovation. I'm hoping that many more companies see graduation, not just as between funding rounds, but as you said, actually graduating to a different path. And that path doesn't need to be triple, double. It can be a sustainable business where, shareholders and founders are successful and they have a meaningful return of some type. Fantastic. Gentlemen, thank you so much for your time today.
Thank you.
Thank you so much for listening to Making the Grade. We really hope you enjoyed today's episode. If you have any questions following this episode or you'd like to recommend a guest perhaps for our next season, please let us know at podcast@scalewise.com. And if you did enjoy today's episode, please do consider leaving us a review on either Apple Podcasts or Spotify. We'd really appreciate that. As this is a brand new show, reviews really help us spread the word and reach new listeners. Plus, we'd also love to hear what you're enjoying about our show. Thank you so much for your support and see you soon for another episode of Making the Grade.